A 1% fee sounds like a rounding error, so almost nobody ever checks it. But run that same 1% fee across a 40-year investing career and it quietly walks off with about $300,000 of your money. Not $300. Not $3,000. $300,000, gone, without a single alert on your statement. Today I am going to show you exactly where that $300,000 goes, and why the smallest number on your account quietly does the most damage of all. Here is why the fee on your investments is so easy to ignore. Look at your 401k or brokerage statement and the fee is not a line you actually pay. There is no bill, no due date, no withdrawal you approve. Your fund simply schemes its 1% off the top of your entire balance every year, automatically, before you ever see a number. You feel the loss only decades later, as a retirement that is quietly smaller than it should have been. A 1% fee is invisible by design. You do not have to take my word for how much a 1% fee costs. The U.S. Department of Labor spells it out in its own booklet, A Look at 401k Plan Fees. Their example is blunt. Take an account left to grow for 35 years. Raise the yearly fees by just 1 percentage point, from 0.5% to 1.5%, and the final balance shrinks by 28%. That is the government's own math on retirement fees. 1 extra point of fees quietly erases more than a quarter of your savings. The reason a 1% investment fee hits so hard is what it is charged on. A 1% fee is not 1% of your gains. It is 1% of everything you have invested, taken every single year, whether the market went up, down, or nowhere at all. Say you have built a $1 million portfolio. That 1% fee pulls out $10,000 that year alone, for doing nothing you can point to. And as your balance grows, the dollars the fee takes grow right along with it. Let us put two real investors side by side on investment fees. Both invest $500 a month for 40 years. Both earn the exact same 7% market return before fees. The only difference between them is the fee. The first picks a low-cost index fund charging 0.04% and finishes with about $1.3 million. The second holds a fund charging 1% and finishes with about $1.0 million. Same paycheck, same market, same 40 years. One investor simply kept more of what the market handed back. Watch the low fee and high fee paths pull apart over time and the damage becomes obvious. For the first decade, the two portfolios look almost identical, separated by a rounding error. Nobody would ever switch funds over a gap that small. But a 1% fee compounds against you every year, so the two lines slowly peel apart, then gap wide open near the end. By year 40, the fee has quietly carved a canyon between the investor who paid 0.04% and the one who paid 1%. Add up that widening gap between the two funds and it lands on a brutal number. The investor who paid 0.04% ends near $1.3 million. The investor who paid 1% ends near $1.0 million. The difference, purely from the fee, is about $300,000. Neither person invested a dollar more or less than the other. That $300,000 was not lost to a market crash or a bad stock pick. It was handed to a fund, 1% at a time, for an entire lifetime. Here is the $300,000 loss measured a different way. Over those 40 years, the 1% fee did not just shave off a thin slice. It ate about 23% of the entire fortune you would otherwise have retired with. Picture your final nest egg, then quietly delete nearly a quarter of it. That is what a single percentage point does when it is allowed to compound against you for 4 decades. The fee feels tiny on paper. The bite out of your retirement is anything but. Now compare what you put in against what the investment fee took out. Over 40 years at $500 a month, you personally contributed $240,000 of your own cash. The 1% fee, through the money it skimmed in the growth that money never got to earn, cost you about $300,000. Read that again. The fee drained more than every single dollar you ever deposited. You were not even the main beneficiary of your own retirement account. In this version, the fund quietly was. So what do real funds actually charge in fees? A basic index fund from Vanguard or Fidelity now costs around 0.04% a year. According to Morningstar, the average fund investor pays about 0.36%. A typical actively managed fund runs closer to 1%. And once you stack a financial advisor on top of the fund fees, plenty of people quietly pay 2% a year, all in. The gap between 0.04% and 2% does not sound like much on a page. Spread over a lifetime, it is a completely different retirement. The Securities and Exchange Commission ran its own version of this fee math. In an investor bulletin on fees, the SEC took a $100,000 portfolio growing for 20 years. It compared a 0.25% fee against a 1% fee. That 3/4 point difference, on just $100,000, cost about $28,000 in the end. No extra risk, no worse investments. $28,000 quietly vanished purely because one fee was higher than the other. The regulator whose whole job is protecting investors is telling you plainly that fees matter. Now let me show you the fee version that should genuinely worry you, because it is one of the most common ones. Plenty of people do not pay 1% on their investments. Between an actively managed fund charging around 1% and an advisor charging another 1% to manage it, they pay closer to 2% a year, every single year. It feels perfectly reasonable. It is 1 point of fund and 1 point of advice. But at 2%, the quiet math we have been running turns from painful into staggering. Run that same investor at a 2% all-in fee and the result is bleak. Instead of the $1.3 million they would have had at 0.04%, they retire with about $763,000. The 2% fee quietly cost them roughly $535,000. That is more than 40% of their entire potential nest egg, gone to fees. Doubling the fee from 1% to 2% did not simply double the damage. It nearly doubled it again, because at 2% even less of your money is ever left behind to compound. Here is the mechanism that makes investment fees so vicious. When a fund takes 1% today, you do not just lose that 1%. You lose everything those dollars would have earned for you for the rest of your life. A fee removed at age 30 is a fee that can never compound its way to age 65. This is compound interest running in reverse, quietly, on the fund's behalf instead of yours. The exact same force that builds your wealth is the force draining it. The good news about investment fees is the rarest thing in personal finance, a huge problem you can fix in a single afternoon. You cannot control the market, but you fully control your fee. Open your account, find the expense ratio on every fund you hold, and read the actual number. If it says 1% or higher, a broad index fund charging around 0.04% does nearly the identical job for a tiny fraction of the cost. Switching from 1% down to 0.04% can quietly be a $300,000 decision. But here is the catch almost nobody checks, and it is the whole reason investment fees stay hidden. Your statement proudly shows your balance going up, so everything feels fine. It never shows you the invisible second account, the one holding the $300,000 the 1% fee siphoned away. You will never get an alert that says you lost a fortune to fees, because from the fund's side, nothing went wrong at all. The only way you ever see that number is if you go looking for it. So let us come back to where we started, that quiet $300,000. It was never a story about picking better stocks or timing the next crash. It was one number, the fee, that you can find on your own statement today and change this week. Check the expense ratio on every fund you own, and if it is anywhere near 1%, you just found the easiest raise of your life. Now tell me in the comments, what is the expense ratio on your biggest investment? Go look it up right now and drop the number below.